Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Markets remain volatile, with the CBOE VIX and MOVE index still elevated. The S&P 500 fell 2.4% last week, but the decline masked sharp swings, with intraday moves over 7% on 3 of 4 trading days. Despite the loss, the tone was broadly risk-on after a 90-day pause on reciprocal tariffs was announced. Previously lagging areas rallied, led by the Nasdaq, technology, and high beta stocks, while defensive sectors and low volatility factor underperformed. Treasury yields reversed sharply higher, with the 10-year rising to its highest level since February 20th. High-yield bonds outperformed during the relief rally, although credit spreads remain near a 17-month high as uncertainty and stress spread to the bond market. USD has weakened to a 3-year low amid the uncertainty, while oil trades near a 4-year low. Markets have experienced several significant multi-standard deviation events in recent weeks. Until more clarity, we expect volatility to remain elevated and asset gains to be limited. Key takeaways. The consensus was that the global economy couldn't handle the proposed tariffs, and a deal would be made. The market applied pressure to the administration to change course, and it was rewarded on Wednesday when reciprocal tariffs were paused for 90 days. Implication: the equity market gapped higher after the announcement, removing a major tail risk and narrowing the outcomes range. The hardest hit factors and companies rallied the most. The market was primed to bounce on any good news. Historically, readings at or below 3 have signaled attractive buying opportunities. However, the market gave back nearly half of those gains last Thursday. As we've highlighted in recent editions of the Weekly Note, the current reading reflects the lack of volatility in recent years rather than investor capitulation. Implication: when volatility rises from such a low base, moves can appear bigger, contributing to feelings of the sell-off being overdone. In recent years, a powerful market psychology has taken hold. Buy the dip. Periods of market volatility have often been followed by swift recoveries, as the Fed responds with rate cuts or quantitative easing. Dips have become less about fear and more about opportunity, a trend that has reshaped how investors respond. Implication: many investors were eager to buy the dip this week after years of being conditioned to expect rebounds. The policy uncertainty and an eagerness to buy the dip are fueling volatility. It's a risky setup that can produce sharp, unpredictable swings, like on Monday when markets surged and then quickly reversed on unconfirmed news of a 90-day pause. When the pause was confirmed last Wednesday, the S&P 500 produced one of its best days in history, only to give back a portion of the gains on Thursday. Implication: volatility is high as investors chase headlines, and it's unlikely to calm down until there is clarity. Even with the 90-day pause, uncertainty remains. A blanket 10% tariff is still significant, which is getting overlooked given the extreme proposed rate levels. The economy could avoid a recession under 10% baseline tariffs, but it would still be a big shock to the global economy and financial system. Implication: rising policy uncertainty has weakened sentiment, causing consumers and businesses to delay purchases and other decisions. The 90-day pause provides immediate relief to the market, but it still leaves businesses in a very uncertain environment. Our outlook is unchanged. Our U.S. Risk Demand Indicator, USRDI, remains risk-off at 1.25. Note, it has remained negative since Feb 26th, with pain in the equity market spreading to high-yield bonds. While valuations have declined, the S&P 500 trades at over 19x its next 12-month earnings, above pre-pandemic levels. Markets are pricing in policy uncertainty and a mild slowdown, but equities have a further downside in the event of a recession. Implication: the market experiences bigger drawdowns in risk-off regimes. The takeaway: buy the dip in risk-on regimes, but sell the rip in risk-off regimes. Thank you for listening. For additional information, please visit MRAadvisory.com.